On a Friday morning in May, the United States economy added 172,000 jobs. That figure was more than double what most economists had projected, while the unemployment rate remained steady at 4.3%. Under normal circumstances, this would be a clear political win. In a standard economic environment, a labor market this robust would drive stock prices higher as investors cheered for a resilient consumer base. Instead, the Nasdaq crashed 4.18%, its sharpest single-day decline in 2 years. The S&P 500 followed, ending a 9-week winning streak that would have been the longest since the mid-'80s. In just 6.5 hours, $1.7 trillion in market value vanished. NVIDIA alone lost $300 billion in a single session, falling below a $5 trillion market capitalization for the first time in months. This reaction suggests that the traditional relationship between jobs and stocks has inverted. In the current U.S. economy, positive data is being treated as a risk, exposing a structural trap where economic strength creates financial instability. The mechanism behind this crash lives at the Federal Reserve. The central bank uses interest rates to balance the economy, and they are forced to react when the data suggests things are moving too fast. A strong labor market keeps consumer spending high. When demand for goods and services doesn't slow down, it provides the fuel needed for inflation to stay elevated. Geopolitical factors have made this balance even harder to maintain. With oil prices moving above $110 a barrel, energy costs pushed inflation to 3.8% in April, the highest level in nearly 3 years. Because inflation remains sticky, the Federal Reserve cannot justify the interest rate cuts that investors have been betting on since the start of the year. Markets have moved from pricing in rate cuts to an 82% probability of a rate hike by December. The entire monetary outlook reversed in 5 months. Every asset class valued on lower rates is now repricing for a high-rate environment. This jobs report provided the final piece of evidence for the market. As long as the labor market stays this strong, the era of easy money is unlikely to return anytime soon. This shift is particularly dangerous for the tech sector, like NVIDIA and AMD no longer match their future earning potential. Compounding this pressure is the upcoming SpaceX IPO, valued at $1.8 trillion. It is scheduled to raise $75 billion in new capital just 1 week after the jobs report. That $75 billion has to come from existing portfolios. Institutional funds must sell their current tech holdings to free up the cash required to participate in the SpaceX offering, creating a massive drain on market liquidity. To find even more cash, the offering is targeting retail investors with lowered minimums. This allows early insiders to exit their positions at peak valuation by passing the shares to a wider net of smaller investors. High borrowing costs are challenging the long-term growth narrative of AI, while the SpaceX IPO is pulling immediate liquidity out of the system. Together, these forces acted as the hammer that broke the market's winning streak. Since 2020, the U.S. stock market has largely detached from real economic health. Instead of tracking GDP or jobs, it has become a barometer for interest rate expectations and central bank liquidity. This creates a binary trap for the Federal Reserve. Choosing path A and cutting rates risks triggering runaway inflation. Choosing path B and keeping rates high means the stock market sells off and the government's cost to borrow money increases. That cost is already significant. The U.S. government pays $1 trillion a year in interest alone. Roughly 19 cents of every tax dollar collected is spent before it can ever be used for services or infrastructure. The modern U.S. economy is currently defined by 2 opposing needs: a stock market that requires low rates to maintain its valuation, and a labor market that is producing the very inflation that makes those low rates impossible. On Friday, these 2 forces collided, and the stock market took the hit.